On March 23, 2020, the S&P 500 bottomed at 2,237. The market had lost nearly 34% in 4 weeks. And while most investors froze, a small group of people opened a document they'd been preparing for years. A watch list. And they went shopping. Here's the truth nobody tells you about value investing. The hardest part isn't finding great businesses. It isn't even valuing them. It's being ready when the market finally gives you the price you want. I've watched this play out for 50 years. The investors who get rich aren't the ones with the best stock picks. They're the ones with the best preparation. Today, I'm walking you through the exact system I used to build a watch list, the same framework Buffett, Munger, and Peter Lynch have relied on for decades. By the end of this video, you'll have a 4-step process you can start tonight. And step 3 is the one most investors skip entirely. Charlie Munger once said, "The big money isn't in the buying and selling. It's in the waiting." Think about that. Waiting. Not researching, not trading, not predicting. Waiting. But here's the catch. You can't wait for something if you don't know what you're waiting for. Warren Buffett tells a story about Ted Williams, the greatest hitter in baseball history. Williams divided the strike zone into 77 squares. He only swung at pitches in his happy zone. Everything else? He let it go by. Even if it meant a called strike. That's a watch list. It's the difference between reacting to the market and hunting with discipline. Buffett waited 50 years to buy Apple at scale. He'd understood the business for years. But the price wasn't right. In 2016, Berkshire started buying. Today, Apple is Berkshire's largest holding by far, worth over $175 billion at peak. 50 years of waiting. One decision. Generational wealth. And here's where most investors fail: they don't wait because they have nothing ready. So they grab whatever's trending. Let's fix that. There are around 6,000 publicly traded companies in the United States. You don't need 6,000. You need 20. The first filter is the most important and the most ignored. Circle of competence. Peter Lynch put it simply: buy what you know. But he didn't mean buy your favorite brand. He meant invest in industries where you have a genuine edge understanding the business. Ask yourself 3 questions. What does this company actually sell? How do they make money? What could destroy them in 5 years? If you can't answer all 3 clearly, that company doesn't belong on your list. When Buffett bought American Express in 1964, right after the salad oil scandal crushed the stock, he didn't buy because he was a finance genius. He bought because he sat in diners and watched people pay with their American Express cards. He understood the trust. He understood the business. That's circle of competence. Boring, slow, unsexy, and it wins. Once you've narrowed to companies you understand, you apply 4 filters. This is where most investors stop being investors and start being gamblers. Filter 1. The moat. Does this business have a durable competitive advantage? Coca-Cola's brand. Visa's network. Costco's scale. Moats let companies earn high returns on capital for decades. No moat, no spot on the list. Filter 2. Financial strength. Pull up the balance sheet. Is debt manageable? A rough rule: total debt should be less than 3 times operating income. If a recession hits, can this company survive without diluting shareholders? Filter 3. Return on equity. You want businesses that consistently earn 15% or more on shareholder equity, without using heavy leverage to get there. This is the engine of long-term compounding. Filter 4. Reinvestment. Can the company put its profits back to work at high returns? Or does growth require more and more capital for smaller returns? The best businesses reinvest every dollar and produce more dollars. Amazon did this for 20 years. When Buffett bought See's Candies in 1972 for $25 million, the business was earning roughly $4 million pre-tax. Over the next 40 years, C's returned more than $2 billion in cash to Berkshire. Why? Because every single filter was green. Small business. Massive moat. No debt. Incredible reinvestment economics. That's what you're hunting for. Now, the step most investors completely skip. You've got 20 great businesses on your list. You understand them. You've verified the quality. But without a target by price, you're just window shopping. For every company on your watch list, write down 2 numbers. Your estimate of intrinsic value per share. And your buy price, which should be at least 30% below that. Why 30%? Because you will be wrong. Your estimate is an informed guess. The margin of safety is your protection against your own mistakes, and against things you couldn't possibly know. Ben Graham called this the central concept of investing. Not growth forecasts. Not technical patterns. The spread between value and price. In March 2020, quality businesses like Disney and American Express dropped 40-50% in weeks. If you had a watch list with buy prices, you weren't guessing. You were executing a plan written in calmer times. And that's the whole game. Here's the principle that will change how you invest, forever. Great investors don't think on the fly. They think in advance. The watch list isn't a wish list, it's a weapon. You build it slowly, carefully, during years of quiet markets. And then one day, panic arrives. Prices collapse. And while everyone else is selling, you're reading from a list you wrote years ago. That's what separates investors from speculators. Not intelligence. Not information. Preparation. The list is the weapon. Patience is the trigger. So here's my question for you. How many companies are on your watch list right now? Drop the number in the comments, I read every one. If you have less than 10, you've got work to do this weekend. Hit subscribe if you want more practical frameworks like this. Tomorrow we're going deep on a topic that's even more uncomfortable: why most investors underperform the very funds they own. You won't want to miss it. Stay patient out there.